Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So last night, the Florida Panthers won the greatest trophy in sports. Of course, I'm talking about the Stanley Cup. It is without question the hardest trophy to win. It is. Fight me. Typical hockey player, right? Fight me. But I am a hockey player. But think about it. You have to win 4 best-of-7 series in order to lift that cup. And each game features bone-rattling hit after bone-rattling hit. I don't think that, unless you've played the sport, you can even fathom what it takes to win that trophy. And the things that hockey players will do to win a cup will boggle your mind. Victor Hedman, he's a defenseman for the Tampa Bay Lightning. He broke his foot in Game 4 of the Lightning series against Florida earlier this year. And he went ahead and played Game 5, logging 26 minutes and 37 seconds of ice time and getting 2 assists in the process with a broken foot. And then last night we found out that Matthew Tkachuk, who is one of the star players for the Florida Panthers, he played the entire playoffs with his abductor muscle torn away from the bone and also, quote, some kind of hernia thing. I mean, boy, you talk about some tough dudes. So what's the big deal about the Stanley Cup? Well, any player's going to tell you that that cup is priceless, right? Winning a championship, being immortalized on the iconic trophy is the ultimate dream of every kid who ever laces up ice skates and picks up a hockey stick. You get your name engraved on the cup as a winner. Every player who won it is on that cup. Pretty cool. Now, you might be wondering, what is the cup itself worth? Like, they say it's priceless, but obviously it's a physical thing. It has value. Well, as it turns out, it's pretty hard to pin down the actual value of the cup, but we do know it's valuable enough to have its own bodyguard. Phil Pritchard serves as the keeper of the cup, and he and his cohorts travel everywhere with the trophy to make sure it stays safe. If you happen to watch the game last night, as the clock was winding down, you saw Phil, with his little cloth polishing up the cup. So it actually has its own bodyguard. But as far as the monetary value goes, the best estimate that you see floated around out there is it's about $650,000. I'm not really sure how they came up with that, but that's the number you find out there on the interwebs. But here's the interesting thing. The silver alone is worth a pretty penny. Yes, the cup is made of silver, almost entirely of a silver nickel alloy. So from what I could gather, it contains about 459.74 troy ounces of silver. So if you take the current silver price, the melt value of the cup, or I guess I should say the melt value of the silver in the cup, is worth right now about $17,144. Think about that. That's a lot of money. It's a lot of silver. In comparison, the melt value of the much smaller Lombardi trophy that's given to the NFL champion, it weighs 7 pounds, and its value, given the current price of silver, is about $3,800. So this goes to show the value of silver, right? By the way, the Stanley Cup is the 4th most expensive trophy in sports in terms of how they valued it. And you might be wondering which trophy in the sporting world is worth the most. Well, to win that one, you got to play soccer. Much easier to play. You can pretend like you're hurt instead of actually being... Sorry to all you soccer fans out there. Had to get that little dig in. But anyway, the FIFA World Cup trophy is actually made out of solid 18-karat gold, and it weighs over 11 pounds. So the melt value of the gold itself comes in at well over $100,000. But they estimate the value of the trophy at over $20 million. And, you think about it, soccer is the most popular sport on a worldwide basis. So, when you look at that, you've got this much smaller trophy that is worth much more in terms of metal value. It underscores the difference between gold and silver. But right now, silver is actually catching up with gold a little bit. And I talked pretty extensively last week about the breakout in silver, so I won't go over all of that again, but I did want to mention that as of this morning when I started recording the podcast, silver was holding over $37 an ounce. Haven't been at this level in years. And we're getting close to testing what I expect is going to be the next significant resistance level, which is around 37.50. And once that becomes support, once we break through that, I really do expect silver to run pretty quickly toward its all-time high of $50 an ounce. And that seems to be the consensus of a lot of folks who are carefully watching the silver market. We see this recent breakout in silver as well in the gold-silver ratio. When I looked last, it was really close to 90 to 1. I think it was 91 to 1. So what that means is it takes about 90 ounces of silver to buy 1 ounce of gold. The gold-silver ratio is simply gold priced in silver. And so it gives you the relationship between those two metals. And the ratio was 103 to 1 not too long ago. So you can see how that ratio is closed, which means that the value of silver has gone up faster than the price of gold. So it does appear that silver is finally at least starting to play catch up, and I mentioned last week, the biggest question that I've gotten over the last year and a half is, when is silver going to catch up with gold? What's wrong with silver? Well, it's finally happening, and it's not unusual. It usually takes a while into a gold bull market for silver to play that catch up. This is the historical norm, what we're seeing now. But here's the thing. From a historical standpoint, when you say a 90 to 1 gold-silver ratio, that's still really wide. Historically, it's been closer to 60 to 1 in the modern time, or even 50 to 1. So that means that when we're looking at this relationship, silver is still really underpriced compared to gold, and that means silver is at a discount. Silver is on sale. For all practical purposes. So I really do think there's still some buying opportunities out there. If you thought about silver and you thought, well, I might get some silver, there's still time. I think there's still a good opportunity to get in on what I think is going to be a significant silver run. And we've talked about this, as I said last week. Go back and listen to the show. I go into detail about the fundamentals, the supply and demand dynamics, the technicals. All of those things are pointing to a really bullish outlook for silver. But of course, the big news this week has been Israel's attack on Iran and the Iranian response. And unsurprisingly, oil prices spiked. Here locally, we had gas selling as low as $2.89 a gallon. I'm in Central Florida. And yesterday, when I drove by the gas station, it was back up to like $3.09. So we've seen a big spike in the oil price. And gold got a bit of a safe haven bid. We're still kind of settling around the $3,400 level. It's a little bit below that this morning. But the thing that was really interesting to me was the fact that U.S. Treasuries have not gotten much of a safe haven bid. In fact, Treasury yields actually inched up, which indicates soft demand for U.S. debt. Keep in mind that the price of a bond is inversely related to the yield. So as the price of a bond goes up, the yield on that bond is going to fall. And so that's what we're seeing. We're seeing less demand, supply and demand dynamics. Prices are going up, yields are falling. And I would argue that this is one of the biggest stories that's out there in the world of finance and economics that's not getting nearly as much play as it should. It's getting some. It's not like it's going unmentioned. But I don't think people really grasp the ramifications of what's going on in the bond market. And, I talked to Jim Grant, I guess it's been about a month and a half ago. And I'll link to that interview on the show notes because I think it's an interesting discussion on the bond market. Jim Grant is known as the interest rate observer. Bonds are kind of his thing. And he believes that we're entering into a secular bear market in bonds where we're going to see yields creeping higher and higher and higher. And of course, that's really bad news for the U.S. government since it really needs interest rates to come down in order to get some relief from all of the interest expense it's having to pay on the national debt. Because obviously, these people aren't going to do anything about the borrowing and spending. But, I believe that this falling demand for treasuries goes hand in hand with de-dollarization, this movement away from the dollar and towards other currencies, and especially gold. So many countries are worried about being overexposed to dollars because of the way the U.S. and the West, more generally, has used the greenback as a foreign policy billy club. And, whether you think it was right or wrong, the aggressive sanctioning of Russia, locking them out of the SWIFT system, freezing their assets, threatening to sell their assets, right? That makes a lot of people wary of holding dollars. They realize that it can be used as leverage against them. And, it just makes sense. If I know that somebody can use something as leverage on me, I'm going to try to minimize my exposure to that thing and protect myself. So they're doing the logical thing. They're holding fewer dollars. And then, of course, Trump's trade policies are also putting downward pressure on the dollar. And it's the same reason. People don't want to be exposed to something that can be used as leverage against them. I wrote an article last week about the growing number of people in Germany who are calling on the Bundesbank, that's the German central bank, to move at least some of its gold out of New York, bring it home, to minimize the risk of U.S. meddling. I'll link to that article in the show notes page if you want to check it out. But, just as a for instance, the German Taxpayer Federation recently sent a letter to the central bank urging it to bring Germany's gold home. Quote, Trump wants to control the Fed, which would also mean controlling the German gold reserve in the U.S. It's our money. It should be brought back. Makes sense, right? The Bundesbank itself has not made any official statements relating to gold repatriation, and it continues to publicly back the Fed, of course, which it's going to do, claims the Fed is the protector of its assets. However, just because they're saying that publicly doesn't mean that the German central bankers aren't privately uncomfortable with the situation. So it's kind of funny and interesting. When I posted the article about the German central bank on Facebook, some guy commented, and he was mad because he said it wasn't fair to call Trump's policy a weaponization of trade. And, he went on and say, this is an important negotiating tool, and the U.S. has been abused in trade policy, so this is absolutely right, and it's not weaponization, and it's unfair to say that. And, from his perspective, I can see where he's coming from. It probably isn't fair to call it that. But as I told him, his perspective doesn't matter, right? What matters is how the Germans perceive things. You can disagree with their position all you want, but it isn't going to change how they respond, right? They're going to respond based on their perception. Your perception doesn't factor into it at all, right? So you always have to consider the potential blowback from any policy decision, precisely because some people won't see it your way, right? But unfortunately, there seems to be a lot of not too smart people out there who think we can just dismiss blowback because, we don't think it's fair or it's unjustified. It is what it is. And if it's going to happen, you have to be aware of it. It goes back, I mentioned Bastiat a lot because I think this is such an important economic concept. You always have to consider the unseen, right? You can't just look at the seen effects of a policy. You have to consider what could happen that you're not expecting or that may not be as noticeable. And if you don't do that, Bastiat flat out said you're a bad economist. And quite frankly, there are a lot of bad economists out there. Most politicians are horrible economists. So, like it or not, de-dollarization is happening. It is happening for these very reasons. The people who are de-dollarizing will tell you, right? If you read the statements from these central banks, they're telling us exactly why they're upping their exposure to gold and downing their exposure to dollars. It's no secret. And then you add to that America's fiscal irresponsibility, and it makes complete sense that the world is beginning to spurn dollars. Now, don't get me wrong. I'm not saying that the dollar is going to collapse tomorrow. I'm not that doom and gloom. I'm pretty doom and gloom, but I'm not that doom and gloom. But there is no doubt that the popularity of the greenback is waning and that there is de-dollarization happening. And, speaking of fiscal irresponsibility, the May monthly Treasury statement came out recently, and you're going to be shocked by this. Shocking. The Trump administration ran another huge deficit. At $316 billion, the May budget shortfall was the second largest of this fiscal year. And it drove the fiscal 2024 deficit to $1.36 trillion. Now, stop and think about this for a minute. The first time that the U.S. government ever ran a $1 trillion deficit was during the Obama administration. And it was in the first year of the Great Recession. In fact, the U.S. government ran a series of deficits, yearly deficits that were over $1 trillion during the Obama administration during the Great Recession. It makes sense when you think about it, right? When you have a recession, tax receipts go down. There's less money flowing into the Treasury. So that's going to expand the deficit. And then on the other side, the government's doing all of these spending programs trying to stimulate the economy and get it out of the recession. So when you see massive $1 trillion budget deficits, not justifying, but it makes more sense during a major economic crisis. Now, right now, we're not even through the fiscal year yet, right? We're not even through it. We have, June, July, August, September. So we have 3 more months. June, July, August, and September. So 4 more months. And we're already at $1.36 trillion, right? So these are the kind of deficits that just a few years ago were very unusual. Only during an economic crisis, that's become the norm, right? And if we compare it to last year, at this point, through the same period, it was $1.2 trillion last year. So we're above the deficit that was run last year, which was huge. Now, what's interesting is thanks to a healthy increase in government receipts, that the deficit this year was actually 9% smaller than in May 2024, but spending was still up significantly year on year. Okay, so Uncle Sam collected $371.23 billion last month. That's how much it brought in taxes and other revenue. That was a 14.7% increase over May 2024. And this underscores a fact that I've been hammering on for months. The U.S. government does not have a revenue problem. It has a spending problem. And you're not going to fix the deficits. You're not going to address the national debt until you address the spending problem. The Trump administration blew through $687.23 billion in May alone. And by the way, that was 2.5% higher than May of last year. So far in fiscal 2025, again, we have 4 months to go, the federal government has already spent a staggering $4.85 trillion. That's an 8% increase over the same period in 2024. And, it boggles my mind because when I talk about the deficits, I talk about debt, so many people still claim, well, it doesn't really matter. Right? You've got this mix of, well, nothing's happened before, so nothing's going to happen now. You've got that attitude mixed in with the modern monetary theorists who basically just claim you can borrow and spend forever, and it's not really going to matter. So, the fact that treasuries are no longer catching a safe haven bid is exactly why it matters, right? Lack of confidence in the U.S. fiscal situation will lower demand for U.S. debt. It already has. So this is going to force interest rates on U.S. treasuries even higher in order to attract more investors, and that's going to exacerbate the interest problem. So it does matter. It matters in the bond market. And people, the modern monetary people, well, they say, well, we have the reserve currency. So that allows us to, print and borrow a lot more money than we otherwise could. And that's true, but it's not limitless. There's still a borrowing market out there that has to be addressed. And we're starting to see the ramifications of that, right? And the sad fact is that given the political incentives, people in power will always kick the debt can down the road. It's a long-term problem that's going to require very painful measures to fix, deep spending cuts, not just tinkering around the edges, not just getting rid of the wasteful spending that's out there, and there's plenty of that. But they're going to have to get in and deal with the Social Security, the Medicare, the Medicaid, the entitlements. Politicians don't want to create pain, right? That's a quick pathway out of office. So they're going to punt the debt problem and the pain that it would require to fix that, and they're going to just keep spending more money to make constituents happy. That's the political incentives, and incentives matter, right? So it's all well and good, I guess, but the problem with playing kick the can down the road, I say this all the time, is you eventually run out of road. It is not infinite. And the world knows this, and it's exactly why they are ditching dollars and piling up the gold. And we see this very visibly in the shifting makeup of global central bank reserves. Did you know that central banks have gobbled up over 1,000 tons of gold for 3 straight years? A lot of what is driving the recent bull market in gold is central bank gold buying. Because, normally you would see this kind of bull run during an economic downturn, during an economic crisis. And if you look at the data, it appears that the economy is doing okay. Now, I would argue that there's a lot of rot under it. I've been arguing this for a while, and I would argue and will continue to argue that the economic meltdown is still ahead of us, because we still have to reckon with the monetary malfeasance, not only of the pandemic, but going all the way back to the Great Recession. We have not unwound all of that, all of the malinvestments, the debt bubbles, all of those things. They're still out there. They have to be dealt with. It is a boom-bust cycle. We've been in the boom for a long time. The bust is due. But regardless, my point is that the central banks have been driving this gold bull rally in a time when you might not expect gold to be going up as much as it has. And most central bankers apparently think that this buying trend is going to continue. The World Gold Council does a survey of central banks every year, and the most recent survey just came out, I think it was yesterday, and 73 central banks responded to the survey, and 95% of those that responded said they believe central bank gold reserves will increase over the next 12 years, or over the next 12 months. 95%. So virtually all of them believe that the overall level of central bank gold reserves is going to continue to go up over the next 12 months. In other words, central banks are going to continue buying gold. And a record 43% of the respondents indicated that they expect their own gold reserves to expand. So that's much less speculative, right? I mean, they kind of should know because they're in charge of it, right? So almost half of central banks say they plan to expand their gold reserves over the next year. And last year, it was only 29%. So it's almost doubled. Not quite, but almost. So, think about this. It's coming off pretty impressive expansion of gold reserves over the last 3 years. Remember, I said that we've seen over 1,000 tons purchased by central banks. And this is official, by the way. These are the official numbers. And there is a lot more gold that is being purchased by central banks and other foreign government entities than shows up in this official data. And Jan Nieuwenhuis, who writes some very good articles for for Money Metals, he has really dug into this and showed that China, in particular, is buying a lot more gold than they're officially reporting. So when I'm talking about these numbers, I'm talking about what's official, what's on record. They're buying even more gold kind of behind the scenes, especially countries like China. I would suspect Russia as well, and other countries, I'm sure. So I wanted to throw that in there and make sure you understand that this is just the official gold buying. And it's interesting, some of the mainstream news agencies, I think Bloomberg in particular, have started to report on what Jan has been reporting on for several months now. I'll link to an article in the show notes about that as well. But anyway, just to kind of look at the official numbers, last year was the third largest expansion of central bank gold reserves on record. It came in just 6.2 tons lower than the total in 2023, and it was 91 tons lower than the all-time high that was set back in 2022. That was 1,136 tons of gold. So 2022 was the highest level of net purchases on record, dating back to 1950. And of course, that includes the time since the suspension of the dollar's convertibility to gold in 1971. So we're in an unprecedented period of gold reserve expansion. To put it into some context, central bank gold reserves increased by an average of only 473 tons annually between 2010 and 2021. So the last 3 years have virtually doubled what the average was before that. And if you kind of want to look back at a broader perspective, this trend of central bank gold buying actually started a long time ago. We've had 16 straight years of expanding gold reserves among central banks. So as far as the World Gold Council survey, they said it was the largest number of central banks to ever respond. And they said that the increase in participation isn't just about the number. Quote, it is a powerful signal of engagement with gold among the central banking community. Kind of looking at some of the survey answers a little bit more closely, 76% of the respondents said they think gold will hold a moderately or significantly higher share of total reserves 5 years from now. And that was up from 69% in last year's survey. Quote, expectations point to continued gold buying over the next 12 months, reflecting sustained confidence in gold's strategic role amid evolving geopolitical and macroeconomic dynamics. So that was the conclusion from the World Gold Council. And here's the thing, or here's a thing. Gold has overtaken the euro as the second largest share of reserves. It's not so much that gold is replacing the euro. The EU's currency share of global reserves has remained relatively steady. Gold is usurping the dollar. According to IMF data, the dollar's share of global reserve currencies dipped even further in 2024. As of the end of last year, dollars made up 57.8% of global reserves. That was the lowest level since 1994, and it represents a 7.3% decline over the last decade. In 2002, dollars accounted for about 72% of total reserves. So, again, if you look at a chart of the reserve makeup, you will see that euros have been relatively steady. Gold has now overtaken the euro, but it's not because euros have dropped so much. It's because gold has gone up and it's replacing the dollar. That's the bottom line. World Gold Council survey respondents think this trend is going to continue. 73% said they expect their dollar reserves to decline even more in the next 5 years. So let me emphasize this. Central banks are replacing dollars with gold. That's the bottom line. That's the conclusion that you can draw from the data, the hard data that we have, and it's also the conclusion that you can draw when you talk to these central bankers and their plans looking ahead. They are definitely moving away from the dollar and moving towards gold. CNBC recently pointed out that gold has been increasingly attracted to countries, quote, concerned about sanctions and the potential erosion of the role of major currencies in the international monetary system. So, kind of read between the lines there. There's two issues that these central bankers are concerned about. Sanctions, this weaponization of the dollar that we've already talked about, and the potential erosion of the role of major currencies. That is the fiscal irresponsibility, the debt, the spending. You know, I've said this before. The United States is like your drunk uncle. Right? He's at the bar. He's just spending money hand over fist. He's spending money he doesn't have. He's charging it on his Visa and MasterCard. Are you going to loan him more money? Probably not. Not while he is engaged in this irresponsible behavior. And I think a lot of countries are looking at the U.S. They're looking at Uncle Sam. They're saying, dude is drunk and keeps spending money. I ain't giving him no more. So they're trying to shield themselves from the weaponization and the depreciation of the dollar. Survey respondents also indicated that the share of other currencies in the reserve mix, such as euro and renminbi, yuan, that they're going to increase along with gold. So it's not just that gold is going to replace dollars. We're going to see other currencies begin to replace dollars. And, you know, the way I've heard it explained, the term that I kind of like for what seems to be evolving is what they call a multipolar monetary system. And in the past, you primarily had the dollar as the reserve currency. I think the dollar is going to continue to be the primary reserve currency. The the world is going to continue doing a lot of business in dollars, but you're going to see it diversifying. You're going to see more transactions in yuan, more in euros, more in gold, more alternative payment systems. A decentralization of the monetary system, I think, is what we're having going on here. And that's why I say that I don't really think that the dollar is in imminent danger of this immediate collapse, right? But its role is declining, and even a modest decline in the demand for dollars is a problem for the U.S. government because it depends on dollars. I'll get into that a little bit more here in just a second. But going back to the survey, central bankers who responded indicated that the level of interest rates was the most important factor dictating reserve management decisions. That makes sense. Inflation concerns came in as the second most important driver. Remember, when you hear the term inflation concerns, we're talking about devaluation of fiat currency. And it's ironic, the central banks are trying to shield themselves from a situation that they're creating themselves, right? Who inflates the money supply? It's the central banks. It's the governments. And so they're trying to shield themselves from their own policies. Central banks in emerging markets and developing economies have driven the recent central bank gold push. And if you look at the major buyers, you see countries like Poland, Turkey, India, China. So these emerging markets and developing economies. Of the emerging market banks that responded to the survey, the top two reasons for gold buying were inflation, right? Devaluation of the dollar, that was 84%, and geopolitical concerns, weaponizations of the dollars, et cetera, 84%. The survey also asked bankers to rank the relevance of various factors in their decisions to hold gold, and the yellow metal's performance during times of crisis was the most relevant, along with its role as an inflation hedge. So again, this theme keeps coming up, an inflation hedge, because they're devaluing the dollar. They're devaluing all of the fiat currencies. They can't devalue gold, right? So that's why they're holding it. As the World Gold Council summed it up, the world is becoming increasingly volatile and unpredictable, and, quote, diversification and risk mitigation, unquote, have become key drivers of strategic reserve management decisions. Quote, gold's safety, its liquidity, and its return characteristics, the three key investment objectives for central banks, have risen in importance. The trends uncovered in our survey suggest that central banks continue to recognize the benefits of an allocation to gold and indicate that their demand for gold will likely remain healthy for the foreseeable future. So I mentioned that, there's some significant ramifications in this trend for the United States. And the bottom line is the United States depends on the world needing dollars. The U.S. needs the world to need dollars so that the world will soak up the dollars that the Federal Reserve keeps creating in order to sustain the borrowing and spending. The only reason that the U.S. government has been able to borrow and spend and grow to the extent that it has is that it has the privilege of issuing the world reserve currency, and the fact that the world needs dollars allows the U.S. to create more of them. It basically soaks up a lot of the inflation. But as demand for dollars begins to drop, where are those dollars going to go? Well, they're going to come back to the U.S. That is inflationary. That means that we're going to see higher prices in the United States. The drop in demand for dollars will directly impact you because it's going to make the price of things that you need, that you're buying, go up. And we've talked about the interest expense ramifications. As the demand for treasuries drops, yields rise, interest rates go up. It becomes more and more expensive to finance the profligate borrowing and spending. And that creates a kind of a negative feedback loop, right? As it becomes more expensive, you have higher interest expense. That means the government has to borrow even more money just to keep up with the interest payments on its national debt. So this is a huge problem. It does not require a currency collapse to have major inflationary ramifications. Now, if we did have a currency collapse, if it got to that point, then you're talking about hyperinflation. You're talking about, Venezuela, where people are basically just using currency as a napkin. So people need to be aware of this. It matters. Central banks are buying gold for a reason, right? And if you think about it, the reasons that central banks are buying gold are the same reasons you should be buying gold and silver, right? You need an inflation hedge. You need real money. You need assets that are under your control, that aren't subject to the banking system or the whims of the government. You need real money to protect your wealth from the devaluation of fiat currencies. You need real money that's harder for other people to control. You need to lower your counterparty risk. That's exactly what these central banks are doing, and the reasons apply to individuals as well. So, perfect time to call 800-800-1865 and talk to a money metals, precious metals specialist. You know, I mentioned silver, that at $37 an ounce, significant gain we've had over the last year, and especially over the last few weeks, but it is still historically undervalued compared to gold, which indicates that there's still room and that there is still a buying opportunity for silver. And if you talk to a money metals, precious metal specialist, they can tell you more about that. They can help you figure out what products will work for you. If you have questions about how precious metals can fit into your investment strategy, they can help you with that. Fantastic people and a lot of information. So make that phone call today, 800-800-1865. If you don't want to talk on the phone, you can go to moneymetals.com and you can just chat online. And if you don't want to chat with anybody, you just want to buy some gold, you want to buy some silver, you can do that very easily right from our website. There's some great programs that you should check out too. You know, you can include gold and silver in your IRA. There's information about that on the website. We have a monthly installment plan where you can accumulate precious metals over time without having to, you know, plop down $3,400 to buy an ounce of gold. You can buy your gold slowly and build it over time. So a lot of great things to look into. So make that phone call today. So that is going to be a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today, and of course a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do that, you'll also be able to tune into our Market Wrap podcast that airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people in the world of gold, silver, economics, and investing. I really, really appreciate you listening to the show. If you like what we're doing here, please take a moment and give us a 5-star rating. Write a nice review wherever you're listening to the podcast. Share the episodes. It really will help us to grow the show, and I would greatly appreciate it. Thanks again for listening, and I'll be right back here again next week.